Hey guys, welcome back to my channel. It is your girl, the Money Nista, Natasha Varela, real estate investor, tax strategist, business owner, 19 years in audit, accounting, and tax, 13 years at the IRS in large business and international division, examining large entities that report 10 million or more in gross receipts on assets and high net worth individuals associated with them. So, I want to talk about buying shares of property, okay, versus buying physical property because there is a huge impact, and there's a huge impact that's about to occur in the coming years. Okay, all wealth is in the tax code, the United States tax code, and most people don't pay attention to it because they view it as too complex, and that's where it kind of sneaks up behind you and bites you. And once it's done, it's done. So I want to talk about being a physical real estate investor first, and then we're going to talk about shares. And the reason why I want to talk about buying shares, your REITs, and things of that nature, is because recently I came across an article. Many of you have come across it probably. Jeff Bezos backed Arrived Homes. Arrived Homes is a company, a Series LLC, and acquired another $23 million worth of single family rental homes, right? That's a big deal. Now, I'm going to tell you why you should be a physical real estate investor versus buying shares, okay? And then I'm going to tell you the long-term impact. And so with physical property, right, if you're an investor, I'm sorry, my primary resident people, my homeowners that live in their homes, this is not for you guys, need not apply. We're talking about the tax code. The tax code does not favor you guys, okay? So with physical property, you get what we call depreciation. It's a fancy word for an expense. It's a gift from the IRS gods. It says now that your property is a rental property, it is an asset placed in service, and we're going to acknowledge that. And we're going to give you an expense associated with this asset over what we think is its useful life. And to the IRS, it's 27 and a half years for residential rental property, anything under 4 units and under, and 39 years for commercial units, 5 units and over. Okay, and so we're also going to give you what we call bonus depreciation. Guys, these terms, they're just fake complex. It's a fancy word for some more expenses. All right, we're going to reward you some more for being an investor, for being engaged in a business activity, because that's what the tax code likes. And so if you are an investor, you get 27 and a half years of a depreciation expense, right, over the useful life. And then now we have bonus depreciation where the tax code says we know that because this is an asset, you have tenants, leasing, you're in business activities, we're going to give you some expense for your fencing, your driveway, your walks, your garage, things of that nature that are not attached to the actual structure of the house. And we're going to give you some more expense for things that are personal property that is inside the house, right? Most landlords, when you rent, you don't remove the flooring and tell the tenant to get your own flooring. The flooring is in there, right? The refrigerator's in there, the stove, the wiring, the microwave, the kitchen countertops, the cabinetry. You don't make your tenants bring that, or I hope you don't. So the government says we know that these are personal items that are attached to the property, and they also have wear and tear. So we're going to give you some more expense. So what did the Tax Cuts and Jobs Act do? The tax code. It favored business activities, and it said we're going to give you 100% of an expense allocated to these things, right? So I'm going to show you what that looks like. 100%, that's a big deal, guys, right? And 100% runs out this year, okay? But don't worry, you can join the Money Masters Academy. Hit the link in the bio or in the caption. Follow me on IG, _Money You can learn all about it. But bonus depreciation is huge. It will phase out eventually in 2027, okay? And so what does that look like? I have a property that I purchased this year, one of many, and for this property I'll have 23K, right? 23,000 a year in regular depreciation as a landlord. And as a landlord, I'll also have another 100,000 in expenses that I get to take for bonus depreciation for this year, 2022. 100%, okay, allocated to the cost, okay? Now, bonus depreciation only applies to those that have 100% rentals. You've never lived in the property, you haven't inherited the property, you haven't bought it from a linear descendant. 100% rental property. Okay, the tax code says we're going to give you 100% of a cost allocated to these things in the first year. Okay, bonus depreciation is only applicable in the first year that you place your asset in service, but that's okay. It creates huge benefits for years to come, and that's why the tax code needs to be explained to you guys, because many people think, well, who cares after the first year? I'll tell you why, and I'm going to show you an example. Okay, so really quickly, just to bring you guys back in with an investment property, you get to deduct your mortgage interest, your insurance, property taxes, any repairs and maintenance, any legal fees. You get your depreciation we just talked about, and your bonus depreciation, right? Depreciation and bonus depreciation are not things you pay for. You just get an expense. It's like a gift from the IRS saying this is an asset. You're in a business activity. We're going to give you some relief, right? So let's say I have rental income of $70,000. Okay. And let's say all of my rental income for the year, including my rental expenses for the year, included of my bonus depreciation, my mortgage interest, property taxes, for whatever. Maybe it's one property, maybe it's two properties I have bonus depreciation for, and depreciation and mortgage interest. These are just numbers I just want you guys to see. Okay. If you have rental income of 70K for the year, maybe you have a couple properties, 4 or 5, and you have rental expenses of 300K, meaning all your depreciation, all your bonus depreciation, mortgage interest, property taxes, all of that stuff. You essentially, in this example, have no tax liability because that 300,000, which is inclusive of the bonus depreciation, offsets all of that 70,000 in rental income. You have no tax liability. Now I know what you're saying. What happened to the other 230,000, right? Because 300 offsets 70,000 really easily. You have 230 left. You get to carry it forward to the next year and offset future years, right? Offset future rental income for future years. That's why bonus depreciation is important. Okay? Remember that. Now, we talk about this a lot. I won't go into too much detail, but if you keep following me, if you join the Money Masters Academy Tax Strategies Mastermind, I'll put the link below. You'll understand real estate professional status is also a huge factor. What is real estate professional status? It says we are going to recategorize, right? Because the government loves business activity, and business activity is not passive, it's active. So we're going to recategorize your passive income, rental income, right, to active income. And what does that do? That means any of these losses that are created, right, in this example, are going to offset all income, no matter where. Another business, maybe you got consulting income, maybe you got some W-2 earnings, but you have to meet real estate professional status criteria. And that means hours requirements, that means involvement. Okay? So, and you don't need to be licensed by your state jurisdiction. You just have to be material and active participant. Again, I go over that in the Money Masters Academy. Feel free to join the live webinar. Feel free to join the Tax Strategies Mastermind inside the Money Masters Academy. I'll have both links in the caption. But in this example, we have rental income of 70,000 again. But this time, we have some other earnings of 130,000. Okay, I still have my same rental expense of 300K, all my depreciation, my bonus depreciation, mortgage interest, all that good stuff. I still have no tax liability, right? 130,000 plus 70,000 in income, that's 200,000. Well, I have 300,000 in these expenses, right? That creates this loss. I still have $30,000 left over of loss that I get to carry over to future rental years, and maybe if I'm still a real estate professional, future years, period. Right? I didn't really pay 300,000 in expenses. I got this gift from bonus depreciation and depreciation. Okay? This is why physical real estate is important, you guys. It's going to have a major impact on your ability to generate significant ease for your kids and whoever your inheritance are. And so let's go back to buying shares. Buying shares of property. So I'm going to pull up the website. Okay. This is Arrived Homes. This is the Jeff Bezos backed company. They purchase single families. I don't know if they have multifamilies, but I think it's mostly single families. And right here in the description, it says buy shares of properties, earn rental income and appreciation. Let Arrive take care of the rest. So the draw is, hey, you don't have to put down, 20% for an investment property, or you don't have to put down 5% or go for an FHA loan. You don't got to go for, all of this, submitting your income. Let us do the heavy lifting. Don't worry about submitting your tax returns, your debt to income ratio. Don't worry about it. You can invest for as little as $100. That's great for people like me who maybe want to see what's out there. But if you have no physical brick and mortar, I'm going to show you why it's important. Okay. And so, true to form, your girl is a tax gal. I am a tax expert. I always find out what the tax implications are all the time. Okay, so let's go through the tax tab from Arrived Homes. Do investors benefit from depreciation? So let's click on it. Investors are able to get the tax benefits of depreciation, which lowers the taxable income of a property. The amount of depreciation will not be specifically broken out on the tax forms that Arrived provides. Instead, you'll get your 1099 DIV. You guys know what that is? If you don't, 1099 dividend income. Okay? It will just show the net amount of taxable income from whatever share you purchase, which is probably going to be 100, 200, maybe even 5,000. I don't know, you guys. But my point is, this is not as great as physical real estate. Okay? So let's go back. What are my tax obligations and what documents will arrive? Right? That's your 1099 DIV. Okay, with regard to tax structure, we elect each property series LLC to be taxed as a REIT, real estate investment trust. Okay, it allows us to report on a 1099 form. We will send you the corresponding summarized tax disclosures. You'll get your 1099 form. Okay, so it's just a form. You can easily do that yourself in your taxes, your input it or your preparer. Can I do a 1031 exchange with Arrived Properties? At this time, it is not possible. But you can with brick and mortar. Okay? Now, it also didn't mention bonus depreciation. So that is a key player. Okay? Will investing with an IRA trigger the unrelated business taxable income, right? I won't really go into this. This is not something you need to worry about right now. Most of you guys are elementary investors, and a lot of people think, I'm just going to go into a REIT. I'm just going to go into shares, like a stash. This is like a stash for homes, and invest. You won't get a 1031 exchange benefit. You won't get bonus depreciation, and you doggone sure won't get real estate professional status. And real estate professional status offsets all income, not just passive income. That is where your wealth is. That is where your wealth is. And you don't need to be a licensed professional, okay? Real estate professional status requires a certain amount of hours and material and active participation. Buying shares is not material or active participation. You will not be able to offset all other income. That is the key. Do not be fooled by the man behind the curtain. Okay, so now let's go and look at some items. Okay, let's look at the homes you can invest in. So they have it structured here. Okay, here's an example, the Chitwood. Okay, they have all the information. I haven't signed up. I don't think I will because I know better. I'm not saying you should or shouldn't. I'm telling you, don't be fooled. Here's the purchase price. Here's the monthly rent that is collected. Okay, let's go into the Dolly. The same thing. Okay, here's the purchase price, right? Here's the monthly rent that is collected by whomever rents here. So essentially, this is what can happen. You can invest in all of this good stuff. You will get no real tax benefit, right? Your girl, Natasha Varela, the Moneyista, has no tax liability, and I have no housing cost. This will not happen for you if this is the way you choose to go. Solely. Okay? Essentially, I will give you an example. You will invest in these things, which is fine. There's nothing wrong with it. I am not against Arrived Homes, but I'm telling you, as a true wealth builder, you will invest in these items via your shares, right? You can end up, just an example, renting from an Arrived Homes company, property owned by Arrived, and you will pay that rent. So you're basically paying yourself to invest in a property you have to pay rent in, right? I'd have to pay rent, if, for example, in the Dolly. Okay, if I don't have any aspirations for owning brick and mortar, right? I invest in, let's say, the Dolly. If I end up in this position, because all of these homes have a very high rent, $38.95. Let's see, the Kennedy, $38.95. Okay. Let's see, most of them $21.90. These are very high rents. So let's say I'm investing in Arrived, right? They're buying millions and millions of dollars worth of property. Let's just say the chance of me ending up being a renter because I don't want to invest in brick and mortar because I don't want the heavy overhead. So I'm paying this rent and I'm receiving dividends from paying this rent. but the rent I'm paying is far greater than what my shares are, right? And I get no benefit. I'm not really building wealth. I'm not saying it's a terrible idea. I'm just providing some color for you guys. So let me know what you guys think. I don't think this is a way for people who are really trying to pull themselves up out of a socioeconomic status that they're currently in. Maybe you want to, start your journey for you, your kids, your grandkids. Um, you want to try brick and mortar. That's where the guts of the wealth is in the tax code. Okay, it's not in REITs. So I hope you guys understand. I hope you guys have some perspective. You know, I wouldn't pay my boss to work for him. Right? So there you go, guys. Have a great one.